Hello, hello. Dan Passarelli here. How are you feeling today? Um, I want to make sure you can hear me. If you can hear me, please make your way on over to the Q&A box and say the word chocolate if you can hear me. If you can hear me, please say the word chocolate. I'm in a snacky kind of mood today, I guess. All right, Daniel. Thank you very much, my friend. Shane is back. Thank you very much, my friend. Anonymous Secret Agent Man is back. Kengo, what's up, my friend? Steven. All right, great. Well, friends, today we're going to talk about, hey, Tomas. All right. Oh my gosh. So many people, so many people. Larry and, oh my gosh, so many people. Vano. Today, we're going to be talking about choosing the optimal strategy to maximize your risk reward. And this, friends, is some important stuff. Before we get started, I need to point out that options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here today is talking about generalized information, not specific to your specific situation. Now, I see some familiar friends here, and I see some new names. So for the new folks, allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular option trading books, particularly option trading or trading option Greeks is my most regarded one, working on my third one. And I am a trader. I traded for years down on the floor of the Chicago Board Options Exchange, the Chicago Board of Trade, CME Group. I traded off the trading floor professionally as well. And now I trade in a retail trading account just like you. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries. It's probably a lot more by that. I think that figure is about 10 years old, so I'm sure we're up to more than that. And we've helped tens of thousands, probably by now 100,000 traders to become more successful. And I am a trading industry collaborator. I work with some of the best options-friendly brokerage firms like Firstrade here and other brokers. And I've worked with every major options exchange globally in some capacity or another, as well as software providers. Just when you're in an industry long enough, you end up knowing a lot of people. Speaking of other people I know, I am also a family man. Those of you who are market taker mentoring student traders already, you are probably familiar with my wife, Kathleen, who runs operations here at Market Taker. I have my two adult children and my two very cute little dogs. One is a Yorkie and one is a Morkie. And I do other things for fun besides trading. I'm a runner, foodie, love to eat and cook, traveler, been kind of all over the world together with my family or through my work in the options industry. Musician, love to listen to music, play it, podcaster, I have a podcast. I have two podcasts and I listen to podcasts all the time. I'm a reader. I'm a gardener. I don't know. What else is there? You run out of hours in the day to do all the things you want to do in life. But I'm here to help you do something in life that's important to you, which is trading. And so, in addition to everything we talk about today, oh my goodness, excuse me. In addition to everything we talk about today, I have another way to help you after we're done here. If you go to markettaker.com, market as in stock market, taker as in take what is rightfully yours, 2 T's in a row, markettaker.com, and you just go all the way to the right, top right here, click on join free. You get some free classes and free resources besides all the great things we're going to cover today to help you to become a better trader. So, choosing the optimal strategy. So here is the thing. Is there anyone here who has never had a losing trade? Hit that questions box. Have you not ever had a losing trade? Is there anybody here? Because anybody who says yes, or me, I've never had a losing trade, I'm either going to call you a liar or someone who's just getting started and you haven't made any trades yet, or not enough trades to have a losing trade. You've had three losing trades. Okay. Trying to remember. Mike, are you a market taker person? I'm having a brain fart here for a second here. Yeah, okay. Yeah, Mike has had. Yeah, I think you were a long time ago. I kind of remember the name. So, yeah, okay, right. I've had three. If you've been around for as long as I think you have, Mike, I know you've had more than three. But actually, you didn't say it wasn't more than three. You just said you had three. So that's fair. So, right. Here's the deal. It's like anything else. Three today. I mean, it's like anything else. If you are like the best, pick your sport, golfer, tennis player, NFL quarterback, if you're the best ever to live, you have lost games or matches or tournaments. It happens. That's not like a perfect track record is not what this is all about. I mean, if you're like a great hitter in baseball, I mean, if you're batting, what, I don't know, what's a great batting average? 400, right? Like you're awesome if you get 300 losers. Right, right. Yeah, man, you've been around for long enough, you're going to have tons of losers. Yeah, baseball players, I mean, if 40% of the time you actually hit the ball to get on base, you're doing great. So 100% track record is not what it's about. It's not realistic, and it shouldn't even be a goal. I mean, well, I mean, it kind of is a goal, right? Any baseball player who gets up to bat, I mean, you always want to get on base, I think, unless there's some sort of strategic sacrifice. Um, you always want to win the game, but and you try to every single time, but you're not going to, and that's okay. It doesn't matter. But here's the deal. It does matter ending the year with a big enough percentage more money than you started with, resulting from the overall trades you made. And in order to do that, you've got to have some combination of big enough winners or frequent enough winners. That's it. There are only two things: big enough winners or frequent enough winners. And look, there are some strategies that are intended to lose more often than they win, and that's okay too. There's a guy named Nicholas Nassim Taleb who wrote the Black Swan and some other books. That was his strategy. He would lose more than he won. But when he won, he would make extremely leveraged profits. And in the long run, made a lot of money. Now, there's some strategies where you have to have significantly higher percentage of winners because your losers are bigger than your winners. So, some combination of making enough and frequent enough. So, here's the thing, it's kind of a fine line. Like, there are some businesses that exist that have profit margins of like a couple of percent. They just make their money on volume. Anybody have like a managerial position or own a business in such a business? Like, isn't it grocery stores and restaurants? Like, you're making a couple percent on capital, right? Isn't that right? Those kind of businesses, if you end up losing 2% instead of making 2%, you're going to end up closing your doors. And trading's not really that different. To make 10%, well, if the S&P 500 goes up 10%, you're going to want to make more than 10%. Otherwise, you're wasting your time here. Just buy shares of spiders and go do something else that's fun, right? You need to beat the S&P 500 in order to, to be successful, right? So if you want to make like 20% a year, it doesn't mean you make 20% on every single trade because you're going to lose some. If you lose half of them, you got to make, well, if you break even on half of them, you got to make 40% on all your trades. If you lose 10% on half of them, you got to make 50% on all your trades. I think that's how that math works. And so this really is a game of small percentages. It really is. Even when we're talking about big potential wins like 50% or something like that, which happen, even if we're talking about that, because your losers are, not just 1%, sometimes they're 10% or 20%, and sometimes they're even 50%. And so because of that, if you could just have winners that are a little bit more frequent than what they currently are, or if you could get an edge on your trades where on every trade you make an extra 2% that you win, and every trade you lose an extra 2% less on every trade, those two things are game changers. Those are seriously game changers. That stuff, just a couple percentage points, can take you from being a losing trader to being a winning trader. There's a phrase that somebody came up with, I forget who it was. Little hinges swing big doors. Little hinges swing big doors. And so with trading, that is, golly, the most true statement I could possibly give you. Little hinges swing big doors. And the best way, there's a couple of different ways to do that. Trading for value, trading for edge, and trading with odds in mind when you do your analysis. And all that leads up to strategy selection. Because look, if you like, let's say, okay, there's two, okay, let's see who's here, who's a regular attendee here. So let's say we got who should I call on here today? Mark. and Shane. I got you, Mark. Let's say Mark and Shane. They, they end up meeting at a conference or in a, like my market taker chat room. And turns out they trade the exact same way. I don't know if you guys do or not. So Mark and Shane are chatting online or email or phone or whatever. And Mark's like, hey, did you see this stock WXYZ? And Shane says, yeah, I was just looking at that. Look at that chart. I think this sucker's going to go up 20% over the next month. And Mark says, holy cow, that's exactly what my analysis showed too. And Shane says, really? And Mark says, really? And they say, all right, yeah, well, let's trade this. And so they hang up the phone or whatever. And Mark goes and buys this bull call spread. And Shane goes and buys these calls. Well, guess what? One of them is going to make more money than the other. And guess what? There's a chance that one of them might make money and one of them might lose money. Or if the trade goes south, one's going to lose more money than the other one. Why? Because they chose different ways to trade it. And neither of those trades, buying a call or buying a call spread, is universally better. We're going to explore that in just a minute. But selecting the optimal strategy for the specific situation, that, friends, is what separates the men from the boys, the women from the girls, the big dogs from the little runt dogs like I have. So let's get into talking about this. Value, edge, odds, and analysis. So the other one of my books, besides Trading Option Greeks, is called The Market Taker Edge, which is all about getting edge on your trades. Because look, when you trade an option, who do you trade with? When you trade an option, who do you trade with? Who's on the other side of your trade? Can you tell me? Anybody? I know somebody can. Mike, Mark, Shane. Market maker. Thank you, Justin. Oh, Justin. Yeah. Oh, yeah. Justin's here too. Yeah. So you trade with the market maker. Yeah. The option seller, Eduardo, if you're buying an option, is 99 times out of 100 the market. The market makers are the ones that give a bid, which is the lower price where you can sell, and the ask, which is the higher price where you can buy. And most of the time, a single market maker is on both sides of that. They say, I'll buy it at this slightly lower price, sell at this slightly higher price. They're trying to make money in the spread. That is the market maker's edge. And it is a cost to all the rest of us. Now, you might say, not me. I always trade right in the middle of the market. Well, if you trade SPY, maybe Apple, maybe Tesla, a couple other stocks, but only a handful. There's like 4 or 5. You might be able to trade in the middle half the time. But usually you put in a limit order and the market changes and your bid or offer that was in the middle is technically not in the middle anymore. The middle changed because the stock went down. Everybody pays that edge to the market maker. My more advanced traders, you're good at minimizing it a lot, but you still pay it a little bit. So besides commissions and fees and taxes, that is another cost that you have. That is another disadvantage that you have. And so it's it's a cost that you have to overcome that edge. Now, all this sounds like, oh, geez, man, I'm already starting in the hole. In that regard, you are. But you can start not in the hole too if you trade with an edge. As a market taker, which is the opposite of a market maker, which is everybody else who's not a market maker, including professionals who are not market makers. If you are trading smartly, trading for value, and optimizing your strategy selection, you can have an edge of your own that can be greater than the market maker's bid ask spread edge and much greater. I mean, commissions and fees are the least of your worries. This is the smallest thing. The bid ask spread is a much bigger cost than commissions and fees. Taxes, I don't know. I don't want to go there. So how do you do it? Well, you have to trade for a statistical advantage. You have to trade for what is called a positive return, which in the options trading world is called an edge. How do you get an edge? Well, you can get it from a lot of different means, and you have to. You have to get it from all possible sources. And the best way to think about it is what if the payout on a trade is 4-to-1, meaning you're risking $1 to make $4. And in options, I mean, those of you who traded a lot of trades, you've made trades like this. A bull call spread or bear put spread, a debit spread is a perfect example. You might risk, it might be a $5 wide spread that you buy for $1. And that's the most you can lose is $1, but it can be worth $5. So your maximum profit would be $4. You've made trades like this. If you've been around the block a lot, if you've made over 100 trades, you've made something close to this. Well, then your odds of success must be greater than what on a 5. You have to have a greater than 20% chance of success, right? And that's a little bit hard to model out when it comes to option trading, but it's pretty easy to conceptualize and to use that concept. And even to just, I won't say subjectively, but not super mathematically entertain the idea of, yeah, you know what? I think I have better than 20% chance of success on this. And if you do, that justifies the trade. So what tools do we have to move us towards this line of thinking? We have what is called the MTM trading path. Now, this is a methodology that I came up with. And the way this works is when I left the trading floor and first started teaching options, I had somebody come up to me and he said, "Hey, Dan, what are the steps that you take to make an option trade?" And the first time somebody asked me that, I just thought that was the dumbest question anybody could ask. Like, what do you mean, what are the steps? You just trade, you just go and you make money. But it's not realistic. It's not even true. The fact is, I did have steps, but I'd just been trading for so long that I kind of forgot what they were. And so it caused me to go back and map them out. It's kind of like when you're driving on a long trip and you're like, oh, wow, we're here at this, gas station with the big statue of astronaut in front of it. Actually, is one of those in Kankakee, Illinois. I think it's in Kankakee, Illinois. Geez, how do we get here? Like, I don't even remember driving the last 30 miles because you're kind of on autopilot. Now, by the way, I don't recommend that. I recommend like forcing your mind to be conscious when you're driving and trading. But, anything that you've done a gazillion times, you have steps, but they just become so second nature that you might not even think about. It helps to go back and think about those steps. It will make you a better trader. It made me a better trader once I did that. And these are those steps. Now, part of the reason why this is a hard thing to do is because if I'm putting together the steps for a covered call, those are this, whatever this is. If I'm putting together the steps for buying a straddle, those seem like completely different steps. And in some ways, as far as the details go, they are. But this trading path, this encompasses sort of the high level or kind of the first principles, if you want to talk like a smart Silicon Valley person. These are the first principles, just the most basic concepts. And then, of course, there's details within each of these steps. And the details would be specific to the type of trade. Is it a covered call? Is it a straddle, or what is it? But if you stick with this, you should screenshot this and print it out and thumbtack this to your wall. And this is going to help you if you always follow these steps. Now, we don't have time to go through this whole thing today. What we do have time to go through is what I call the big four. The big four sources of edge. And that is having skill of technical analysis, fundamental analysis, and volatility analysis. So we're talking about analyzing the technicals, the charts, indicators, analyzing the news or maybe the financial statements if you're good at that, and if the type of trade you're trading warrants that, and analyzing volatility. Why do we have to do that? Well, because the technicals and fundamentals, or the news, that drives the price. And it gives you an idea of the time period that price move might occur over. Analyzing the volatility, well, and so technicals and fundamentals, they help us with our delta and our gamma and maybe our theta, because you will make money on delta, gamma, or theta. Again, that is why my first book was Trading Option Greeks, because you can distill into first principles all the things that affect the value of your options. There's only like about four major ones: delta, gamma, theta, and vega. Oh, wait, we haven't talked about vega yet. Well, let's talk about that. We also have to analyze the volatility. Analyzing the volatility also helps us with gamma and theta, but it also helps us with vega. David says, could you please send me a PDF copy of your book? I'm not following all these nuances. David, I would love to, but I have a publisher, and I don't know if you know much about this publishing game here, but they technically own the publishing rights. So I literally could not legally send you a PDF copy of my book, and I don't even have a PDF copy of my book because I don't need one, because I can't send it to anybody. Just go on Amazon and buy it. They sell it at a discount on Amazon. It's not very expensive. It's $50 or something. Can't afford 50 bucks. I don't think you're that serious about your trading, right? It's called trading option Greeks. Now, and by the way, another thing about publishing is I barely get any money out of that. I just want you to have it because there's important stuff in there. I think I probably make about $2 or something for every book I sell. I don't care about $2. Okay. So all that being said, why are we analyzing technicals, fundamentals, and volatility? Because we're going to make or lose money on technicals, fundamentals, and volatility. We're going to make or lose money on each one of those. So if we think about each one of those and come up with a forecast that includes each one of those, we can then select the optimal strategy that best capitalizes on each four of those. Okay. Let's talk strategy selection. So we use the technicals, fundamentals, and volatility and to come up with the best strategy, which is going to give us an edge. Could make our winners more frequent than they would be with a different type of strategy. Could make our winners bigger and our losers less big than it would be if we chose a different type of strategy. Because then we can actually trade for a statistical advantage. We don't know if we're going to win or we're going to lose, but we know if we always choose an optimal strategy, we can put ourselves at a long-term statistical advantage that adds up and is arguably the skill that pays you by the end of the year. And these strategies are each situational. So let's look at the Bull Bros. These guys are triplets. Bill Bull, Will Bull, and Gil Bull. Have you guys ever heard of these? Triplets. They're very, very famous traders. They're called the Bull Brothers. Look them up. Google them. Yeah, no, it's real. I'm just kidding. I just made these names up. But the Bull Brothers here, they trade just like, who was I talking about before? Mark and Shane. They all use the exact same trading setups. They look at the same indicators, you know, they took the same trading class. Somebody showed them a system and they learned it and they follow it and they make a whole bunch of money based on this system, whatever it is. I'm giving you a hypothetical scenario. But they're all grown-ups now. They got their own wives and kids, live in different houses. And so they all execute trades that are slightly different. They all have the exact same trade setups. They all have the exact same forecasts, but they put on different strategies. So in this one, Bill, Will, and Gil, they're all bullish on XYZ stock, which is a made-up stock that's trading at $50 a share. So Bill decides to buy the August 45 strike calls, 10 of them, at $6.70. So Bill has a delta of 75 and a theta of 1 cent a day. Now, again, if you are not used to the Greeks, we did do a Firstrade webinar on the Greeks. It's been a while. No, it hasn't been that long ago. I think we did it in April. We did like a 4-part series on the Greeks, as I recall. You can go back and watch that and you'll get at least the basics. So Bill bought the 10 of the August 45 calls at 670, 75 delta, 1 cent theta. Will buys 10 of the June 55 calls at $1.15. There's a smaller delta, 35 delta, and a 2 cent a day theta. And then Gil buys 10 of the June 50-55 call spreads at $1.20. Now that has a 21-cent delta and a half a cent a day theta. Okay, there we go. Who makes the most money? Which of these trades is the best? Oh, don't answer because it's a trick question. It depends. And that's why we have to have a very tight setup, because this forecast based on our analysis, because that drives which one of these you would choose. So scenario A, they're all bullish, right? But scenario A, this is how it plays out. Well, made up XYZ stock rises $1 over 2 weeks. So Bill, who is long the August 45 calls at 670 with a 75 delta and a 1 cent a day theta, he makes 61 cents. Why? Because the stock went up $1, so it's 75 cents based on delta, and that was over a week. So it's, oh no, that was over 2 weeks. So it's 14 days times 1 cent. So he made 75 cents, lost 14 cents, made 61 cents. Now, if the stock rose a lot more, I mean, he could have made infinite. He just makes more and more the higher it goes. The most he could have lost was $6.70, what he paid for it. Okay, fine. Will, who did a completely different trade, bought 10 of the June 55 calls at 115 with a 35 delta and a 2 cent a day theta. Will only made 7 cents. So that's 35 delta times dollars, 35 cents on delta, 14 times 2 cents a day theta, lost 28 cents. So yeah, just made 7 cents. Now, Will also could have made infinity, right? Higher it goes, the better. Could have only lost 115 if the stock closed anywhere below 55 cents. Okay. Gil, who was long 10 of the June 50-55 call spreads at $1.20, 21 delta, half cent a day theta, made 14 cents. 21 cents on delta, lost 7 cents on theta. Now, Gil's profits were capped because he had a spread. He could have made up to $3.80. Could have lost up to $1.20 if the stock was anywhere below 50 at expiration. Which of these trades was the best? Well, now we can answer that in hindsight. If we had a time machine and we knew the stock was going to rise $1 over 2 weeks, which one of these would we pick? Well, I know which one I would not have picked. Will's is the worst. One way to think about this is, well, the best way to think about this is return on risk. Will made 7 cents, 0.07 divided by risk of 1.15. Will made 6%. And as far as probability of success goes, the stock was at 50. It had to rise at least $5 just to break even. It actually had to rise $6.15 just to break even. So Will's trade was by far the worst. What about Bill's trade? Well, he made 0.61 divided by 6.7. He made 9%. But he could have lost the most. But percentage kind of takes care of that, you know. Will and Gil probably would have just bought more if they were all risking the same amount of money. Bill kind of started a little bit ahead, though, because he already had $5 of intrinsic value. If the stock just stayed where it was, didn't even go up at all or down, would have been worth $5, so he would have lost less. So Bill was definitely better than Gil, or than Will. Bill was better than Will. How do these parents name their kids Bill and Will? Isn't that the same name? Bill is short for William. What's wrong with these people? So Gil, let's see his. Well, Gil made 14 cents, 0.14 divided by $1.20. That's what he risked. Well, Gil made almost 12%. So Gil made the most. And it didn't have to rise much just to break even. It did have to cover the premium. His break even was 51.20. So I don't know. I mean, I think Bill made the most. Bill's the smartest trader. Holy cow. Well, wait a minute. Let's look at scenario B. Let's say the stock rises $5 to $55 over 4 weeks, which is June expiration. Well, Bill made 350. Will actually lost money. How did Will lose money? It was long calls and the stock went up. Stock went up 10%. How could he have lost money? Well, because of theta. It needed to go, his break even was 56.15 and it didn't get through the break even. Gil made 380. Wow, Gil actually made the most on this and risked the least. Bill's percentage is what, about 45% or something? Gil's percentage is like over 300%. Will must be an idiot. He's got the worst in both cases. But Gil's a smart one this time, not Bill. Okay, well, hold on a second. What if the stock rises $10 to 60 by June expiration? Well, Bill would have made $8.30, which is much more than Will or Gil. But remember, it's percentages. If they were all investing the same amount, would it have been better? I don't know. Let's see. Will would have made 385, lousy, on $1.15. So what's that? 3.85 divided by 1.15. Will would have made 335%. Sheesh. Gil would have made 3.8 divided by 1.2, 317%. Wow, so this time Will is the genius. Holy cow, that's amazing. Will, you're so smart. This time Bill is the idiot. He only made 45%. The other guys made above 300%. Wait, why did Will make more than Gil, though? Will made more than Gil in actual terms and percentage terms because Will invested less. Because it's unlimited profit potential. If this was like, if it went up to 65, Will would beat Gil by even more. What if they were all wrong? The stock fell $5 to 45 over 1 week. Well, Bill would have lost $5.55, which is 5.55 divided by 6.7. Bill would have lost 82%. Wow, that's a kick in the pants, huh? But Will would have lost $1 divided by 1.15, 87%. Will would have lost more. Gil would have lost 0.8 divided by 1.2, only 67%. Gil was the big winner on this one this time. So there are no strategies that are universally better than any other strategy. It depends on what happens. Now, you can't see the future, but I want at least three people to tell me a stock that they're bullish on. Go, hit the Q&A box. Tell me a stock that you're bullish on. And here's what I'm hoping. I'll tell you in advance. This will guide your answers. I want some that are just like, wow, this thing's going to go to the moon. I want some that are nice, conservative, slow plays. Okay. I got three. Anybody else want to throw in like a conservative, slow, boring one? I got one, Verizon. And all of this is hypothetical, not a recommendation. So let's take a little look-see-poo here for a second, shall we? Let's say AMD. What did I do? Oh, I forgot to hit enter. So AMD, it's pretty aggressive. It's pretty aggressive stock, right? I mean, it kind of matches the pattern of the market, but it's more extreme. Just has like a higher beta, right? Not quite up 100% since April 8th. Okay, let's look at CoreWeave here. CRWV, I believe, right? Yes. This one, holy crap. From that same period of time, let's start with April 8th ish. Went from 44 to 180. So it's up like 400% in that same period. Jeez Louise. Okay, whoops, didn't mean to do that. Let's look at Oracle. Oracle and AMD are pretty similar, so I'll stick with AMD, CoreWeave, and one that I'm throwing in here again, just for example purposes. Well, this sure isn't quite as sexy of a chart, is it? AMD was up what, 80%? CoreWeave up 400%. And Verizon, it's actually down, but it's at a base, has strong fundamentals. Probably would take a while for it to play out super nice. My forecast on Verizon would be probably a 1-year time horizon, going up maybe 20%. Again, not a recommendation, just hypothetical. But I'm trying to be reasonable here, right? I don't think it's going to go up 400% over 2 months like CoreWeave. It's a completely different play, which requires a completely different option strategy. What might I use for this? Well, I might use a covered call. Maybe a covered call with selling a long-term call, or buying a leaps at the money put, or buying a long-term debit spread, where I can sell a strike 20% higher and still get enough premium for it. Okay, those are some ways that I might play this. Which one would I actually choose? Yeah, selling a cash geared put. Absolutely. Either one long term one or a series of short term ones. Right, Mark? Okay, so that's what I got. Which one would I actually choose? You know what? I would narrow in on my exact technical analysis and narrow in on my exact fundamental analysis. And I would look, I'd model them out and really think about it and see which one is best. Now so this is like Baby Bear, right? Now let's look at Papa Bear. Oops, Core Weave. Oh, daddy. Look at this thing. What do you think? A covered call on this? You'd be freaking crazy to trade a covered call on this. Buy this. I mean, stocks like this could go up just massively or they'd come crashing back down. It'd be crazy to buy the stock and sell a call, cap the upside potential, but keep all the downside potential. Doesn't make any sense. You definitely want to be buying a call if you're bullish. Maybe if the implied volatility is very, very high, you would have to hedge it off by doing a bull call spread, but you'd want to have a high enough strike where you're not leaving enough money on the table. You'd prefer not to do a bull call spread. You could do a trade like my friend Jenny calls the Jade Lizard. Let me see if I screw this up. I think this is a Jade Lizard where you buy a call and then sell a put spread to help finance the call. Okay. That might make sense. That might make a lot of sense. Completely different strategies than what we were talking about for Verizon. You probably want to keep this shorter term also. Okay. Well, we had Baby Bear and we had Papa Bear. Mama Bear, she's not here. She's at book club, which we all know means drinking wine, not really talking about books. So let's skip over to Goldilocks, which is AMD. AMD, doon, doon. Kind of right in the middle of these two. Still pretty aggressive. It's like Goldilocks on Adderall. Okay, so we got Goldilocks here from the 8th. We were down at about 80 bucks. It's up like what, 80% or something, right? So this is different. Whereas with Core Weave, we really probably prefer not to do a debit call spread. We prefer to have something uncapped because it can just take off so much. Here, maybe something capped. We'd have to look at the option chain and see, hey, if my time horizon is 2 weeks, I mean, with CoreWeave, we'd probably just want a couple week time horizon. With AMD here, we'd probably want a slightly longer time horizon, 2 to 3 weeks, up to a month, probably 2 to 3 weeks. But we wouldn't expect it to move as much in 2 to 3 weeks. Would we? No, we wouldn't. So we might consider capping this to lower our cost because these were red candles. I mean, this was even a down day. We do have some down day. I mean, this was 1, 2, 3, 4, 5, 6, 7, 8, 9. This is almost 2 week period of down days, pretty much down days. Overall down for sure. Overall down a lot, 10% in 2 weeks. So this, yeah, we'd probably want to do like a bull call spread. Probably buying in the money call and selling out of the money call, slightly in the money call, sells and out of the money call at a price where we think we could get to in 2 weeks or 3 weeks and not really blast through. So, all that being said, we want to do our analysis and fit the strategy to the situation or the outlook. And with each of these, I came up with like 3 different potential ideas, initial ideas off the top of my head that might make the most sense. And you should do that every time. You should come up with 3 different ways to trade it and always pick the best way to trade it. Well, how do I know which is the best way? Well, the one that yields, just model it out. Think about it. I mean, you could, there are platforms you can look at that'll draw a P&L diagram for you, or you can draw it yourself and look at the Greeks and say, well, look, if in 2 weeks we're up by this, I make this. But if in 1 week we're up by this, I make this. Which one of these is the best for what I think is going to happen? And which one do I risk the least on? And balance it out. If you go through that exercise, even if you don't know much about options, you're still going to make massively better choices. We do that in our one-on-one coaching program. Help students choose the best one. So, I mean, the guidelines here, let's get rid of this. When you're bullish, you want to start with like long calls, short puts, debit spreads, credit put spread, debit call spreads, credit put spreads. Bearish, same idea, just upside down, just using puts, long puts, short calls, or more like short call credit spreads, debit put spreads. And short volatility too. We might do credit spreads, wing spreads, long volatility, straddle, strangles. And we just want to start with those general guidelines. Start with those go-to strategies. And then, for each one, hey, I think this is going to happen, and write it out. Write out your time horizon, how big of a move you think is more likely to happen, or at least a range, and what you think implied volatility might do if that happens. And then basically look at 3 different ways to trade it and trade the best alternative. And it's just that simple, friends. All right. I hope that helps. Until next week, friends, have a great rest of your week. And we've got, oh my gosh, we've got a whole new batch of trainings for you that you're going to love. I just came up with some brand new topics and they're really, really great. Thank you, Sir Mike. All right. Have a great rest of your day. Trade smart. Catch you next time.